In today's video, we're going to talk about the benefits of incorporating for Ontario realtors as well as business owners. As of October of this year, 2020, realtors in Ontario were given the ability to incorporate their realtor business, prior to which it wasn't allowed according to our license. So this has brought on some interesting opportunities, which we're going to discuss today. Now, to preface this, I'm not a lawyer, I'm not an accountant. If you're going to go down the path of incorporating, it is good to get their perspectives and their advice. What I'm sharing is simply my opinion, but it is coming from the opinion of a realtor who had to decide for himself if incorporating was right for me or not. So I had to get the advice of my accountant, of my lawyer. I had to, run the math on my own situation based on my income, based on my expenses, and what I hope to save every year if I were to incorporate. I hope this can be of value from that perspective. Before we start getting into the meat and potatoes of this video, the one thing I really want to say is if you're just getting started as a realtor or as a business owner, it's almost worth it to stop watching this video altogether. Incorporating your business will be a distraction if you're just getting started in your business. I've just completed the third year of running my realtor business. It is something that is becoming a bigger expense every year, how much I pay in taxes. But when I was just getting started, if this was an option, I believe I would have wasted my time looking into everything that's involved in incorporating, when the priority when you start any kind of business, be it a realtor, be it any other small business, you have to focus on what's going to get you started, what's going to get you moving forward, what's going to get you your first client, and how do you keep them, how do you take care of them, how do you really level up the service you provide. That has to 100% be your focus. All of this is going to be a distraction right in the beginning. So I just want to say that right up front. So let's first go through some of the normal reasons people consider incorporating. So the first corporation that I actually made was, prior to this, I opened up a corporation to hold one of my student rental properties. Basically, I got the advice from my lawyer at that time, and we decided it made sense to incorporate to hold that rental property in the corporation, simply because there were going to be 5 or 6 students living in the property at any time. And it was more from a liability protection standpoint, meaning if something crazy were to happen in the property that was not covered by the insurance, that liability would then go to me or my personal assets. But by incorporating it to a certain degree, you can limit the risk to what's held in that corporation. This is actually not a benefit for realtors. It may be for most small businesses, but as a realtor, we transact sales and deals in our own name, and the license is held in our name. We have our errors and omissions insurance to cover us for any potential issues there. The liability protection does not apply through a personal real estate corporation, because even though the income goes to a personal real estate corporation, you as the salesperson are still doing the transactions and are personally liable. So it's important to know that liability protection is not a benefit for realtors. It is for most small businesses, and it can be for other types of corporations. Going to the next benefit, which is the big one, which most people are interested in with incorporating their business. So that is taxes. With a corporation for an active small business in Ontario, a realtor business would be considered one of the active businesses. You get the benefit of what's called the small business tax deduction, which essentially allows you to pay only 12.2% of corporate income taxes up to the first $500,000 of profit in that small business. So after you deduct your regular business expenses, same as you would if you were a sole proprietor earning the income in your own name, you get that benefit of only paying 12.2% in taxes. However, that is only for the money that remains in the corporation. Alternatively, for example, if you earn over $100,000 in personal net profit as a realtor or any small business owner, your tax rate goes up to 43%. And after $220,000, that's the top marginal tax bracket, you end up paying 53% in taxes. So that's a considerable difference, 12.2 to 53. How does this work though? You can't spend the money personally that is only taxed at that 12.2% tax rate. The money that's taxed at the 12.2% tax rate that has to remain in the business and is what we call retained earnings. There are some advantages to this money. You can invest it, for example, in stocks, bonds, mutual funds, or you can invest it even directly into real estate, like a rental property. So for example, if you earn, say, $200,000 and you live off of 100,000, so you pay yourself a salary of 100,000, the remaining 100,000 can be retained earnings in the business. You'll pay the 12.2% tax, so you may have about, say, 88,000 left in retained earnings in your corporation. You can then go and, say, buy a $400,000 rental property, use that 88,000 as the down payment, and you get to invest your money almost pre-income tax to a rental property. So that's a huge benefit, because if you were to pay yourself the full 200,000, that second 100,000 would be taxed at close to 50%, right? Because income taxes in Canada, they increase as your income increases. So the benefit becomes bigger the more you make. Now, if you're in the situation where, say, in the last 12 months, you have been spending almost everything that you've been making simply because, your business, say, is in its early stages, maybe COVID hit you hard, whatever the case, and your net profit is not sufficient that you can really save a significant chunk in the business, meaning, whatever your business makes, you'll be taking it all out as salaries or dividends. Generally speaking, the advantage of incorporating is not as high. I'm sure there are some advantages in terms of tax planning, and I'm sure an accountant would go into that, but the big benefit of that retained earnings, which I mentioned, would no longer be applicable because you're taking all of it out as a salary or as a dividend. And because of that, you essentially pay the same taxes you would pay had you not incorporated in the first place. So let's go a bit deeper into the benefits of incorporating. I like to consider incorporating similar to setting up an RRSP, right? When you have an RRSP, you get a tax deduction, right? You get to put money into your RRSP, you get a tax refund, and that's money that's going to the RRSP before paying personal income taxes. In a similar way, an incorporation, in my eyes, is that almost that equivalent. You don't quite get the tax benefits of an RRSP for the investments inside it, but you get to take money before paying income tax. You just pay that 12.2% and you get to invest it directly into whatever investment you're comfortable with. And this is, I think, a huge advantage, especially because there's no limit. Essentially, you can make up to $500,000 of profit after your salary. So your salary is a business deduction, and you pay personal income taxes on that salary, but you get to make up to, say, $500,000 in pure profit in your business just at this 12.2% tax rate, which is much larger than the RSP maximum. So you can really do some damage if your business is producing this kind of income. Other than simply saving on taxes, something that I found helpful is stability. So essentially, when you have a business, you put all your business earnings into the company, right? And most businesses, mine included, is very seasonal. You'll have amazing months, you'll have months that are much worse. But overall, throughout the year, if you're doing well, you make a decent income, but it can really be sporadic. So one of the best parts of this is, in order to take money out of the company, you need to either pay yourself a salary or a dividend. And in my case, I'm choosing to take a salary. So this is going to allow me to have a steady, consistent income every single month. And the nice part is, if I have a really good year, I get to retain earnings, right, after paying those lower tax rates in the company, so that in future years, if I have a tough year, I can continue my salary steadily, even if the business isn't doing too well. So it really provides that stability and a bit more security, especially if you're a business owner that also has a home, a mortgage, you have expenses, right? You need to take some profit from your company every month in order to be able to meet those expenses, whether or not necessarily the business did great that month, right? So hopefully, if you have really good months to offset those lower months, incorporating can create some kind of stability, especially between 2 years, because otherwise you would pay a ridiculously high tax rate on the highest end of your tax bracket. If you have a really good year, and then following that, if you have a terrible year, you've already paid those money in taxes, so you don't have that funds set aside in a bank that you can continue to pay yourself. So anyways, just something to consider. The next is regarding automobiles. So when you are incorporated, there are two options for tax deductions when you have a vehicle used for business purposes. The first is the same as any self-employed professional. So if you have a vehicle that you use 80% of the time for your business, you get to deduct 80% of your business expenses, more or less, and you get to depreciate the property if you own it, versus if you lease it, you get to deduct up to a certain amount of the lease payment. Now, when you're incorporated, you have that same benefit, but you can choose to also pay yourself per kilometer. So it's somewhere between 49 to 55 cents per kilometer. And if you're someone like me with a very cheap car, so in my case, I have a 2008 Toyota Camry hybrid that I've used for the last 3 years, getting close to 300,000 kilometers. So it's really up there. I need to, I'm actually planning on getting another car at some point. But anyways, if you have an older car, my car is probably worth $4,000 now. I looked it up. There's not much left to depreciate. That 49 cents to 55 cents per kilometer deduction is considering gas, maintenance and repair, and some depreciation. The CRA sort of calculated that as a broad number that is likely much higher than what I would get to depreciate my car by if I were to do the math and like depreciate it based on the value or based on my purchase price. So by choosing to get paid in the cents per kilometer option, I'll actually get a tax-free benefit from my company. It's a deduction against the business. It's money that flows into my personal account that I can pay my regular automobile expenses, but it'll likely be a higher amount than my actual automobile expenses. So it's a nice little benefit of being incorporated. The next benefit is for healthcare. So if you were working in a company, a larger company before becoming self-employed or before starting your business, you will realize that you lost all of your health benefits, your group benefits, dental benefits. There's a lot that come with being in a larger company. I used to work at one of the larger banks, so they had probably one of the best plans in terms of, dental, healthcare, eyesight, massage, chiropractic. They had all the full list of coverages, right? So as a self-employed, you don't really get much benefit. There's a deduction for personal health expenses. I never looked into it too much. My health expenses aren't too high, but with a incorporation, you get the benefit of what's called a private health services plan. So with a private health services plan, you need to work with an administrator. So these are companies that run the paperwork for it. One example is PREC Health, if you want to look it up. So essentially what they do is for the CRA's list of eligible expenses, which is quite broad, pretty much any expense that you would typically have a benefit covered by a company is probably on that list. If you have any of those expenses, for example, dental, what happens is you get to pay through your personally, you would pay for your dental expense. You would keep the receipt and then you would submit it to PREC Health. They would then take the money out of your corporation's bank account and put it into your personal bank account. And this money is not taxed personally. It's a business deduction. So it essentially flows directly from your net profit directly to you without paying business taxes, personal taxes. So essentially, in many cases, this can be close to like a 50% deduction if you're at the higher income tax bracket. So it's great. You can pay for dental, especially in our case. So I'm married and we have a child coming early next year. So, dental expenses, healthcare expenses, anything not covered by OHIP, more or less will be covered by this. So as a self-employed professional, you don't get the benefit of being part of a group plan, but essentially you can pay for your own expenses with a tax deduction. And I actually like it more than paying for insurance, simply because we're younger, our health expenses are likely not going to be too much, but it's nice to know that when I need to pay for it, I get like this massive tax deduction, so that the actual cost to me is a lesser amount, right? So it's half of whatever I actually pay, more or less. And it's nice to know that I have the benefit, but at the same time, I can be frugal. I don't need to waste money on random things because that's not who I am. I like to save money, so I'm not going to spend money on prescription glasses simply because I know people try to mess around with this, right? They get prescription glasses to get high-end sunglasses, and they do all sorts of funny things to maximize the benefits they have with their company. In my case, I own the company, I'm the employee. I don't necessarily want to waste my business's money. So when I need it, I can use it. And companies like PREC Health, they charge like a 5% fee off of the amount. So essentially you save anywhere from 30 to 50% in taxes by doing this, and then you have to pay 5% to administer it. So I think it's a well worth trade-off. The final one I'm not 100% clear on, but I'm just going to mention it anyways. This is when it comes to partially deductible expenses. So for example, if you have a meal with a client, right now my understanding is it's 50% deductible and the other 50% is not deductible. So if you spend $100 on a dinner with a client, then half of it is a write-off against your business income. The other half you have to pay taxes on. However, if you're incorporated, that expense is a business expense, even though it's only partially deductible. So the other half is paid by money that has only been taxed at that 12.2% tax rate, versus if you're not incorporated and say you're at that highest tax bracket, you would be paying close to 52% of taxes on the half that is not deductible. So it's a small benefit because the half that is not deductible is paid with business retained earnings versus your personal net income. So that is a small benefit from having a corporation. The next is when it comes to, there are other expenses that are also similar to this. I've not looked into it too deeply yet. I'm not an expert. There are life insurance policies that can be purchased by your corporation to provide a tax-free benefit to you. Again, I'm not at the level where I think I need any of that yet. If you are, look into it, right? Ask your accountant, ask your lawyer, ask around, find more information. But partially deductible expenses, it's a small benefit, right? If you have expenses that are eligible business expenses, but the CRA just chooses not to let you deduct all of it, at least you still pay the rest of it with your business's retained earnings versus with your personal income. I know it was a little bit of a longer video. Hope overall this helps, especially if you're a realtor in Ontario, now that we're given this option to incorporate. I hope these can be helpful. The quick answer to all of this is fundamentally, are you making enough money consistently that you can live off of less than the total amount and save the rest in your business? That is, I think, the fundamental question if you're deciding to incorporate or not. And there are more costs that come with incorporating, right? You have to pay an accountant the cost of a corporate tax filing, which is in the 12, I think, to 1,500 range, versus a personal tax filing, which can be $300 to $600 as a self-employed. So there are some expenses, there's some legal fees to set up a corporation. You can do it yourself. It's not super complicated, but if you have a relationship with a lawyer, I would probably just use them. That's what I did. There's costs to consider when it comes to incorporating your business. There are a lot of tax benefits that come if you're in the position to utilize them. And one of the cool benefits that comes afterwards is if you can get to the point where your business is producing enough net profit that you can save up a down payment in your real estate corporation, you can then, through some mortgage programs at some of these banks, you can use the funds to directly buy a rental property in the name of your corporation. And sometimes these mortgages don't even show up on your own personal credit bureau. You have to guarantee the mortgage, but sometimes it doesn't show up on your credit bureau and it's owned in title of the corporation. So again, get legal advice on that. Typically, you would want to set up a separate corporation to hold the property, not your active real estate sales company. You're allowed to do it, but I think it's good generally to keep it separate so that the two businesses don't sort of intermingle. So again, cost there with legal fees and accounting fees, but it's one of the cool benefits from starting out as someone self-employed to incorporating to actually growing your business to the point where you are earning significantly above your living expenses, and then you're really able to utilize that to invest it into real estate or other investments. You can use the same structure to invest into mutual funds, index funds, which I love myself, and many other types of investing. So hope that was helpful. If you like this video, give me a thumbs up. If you watch this video within the first couple months of it being released, I am just shy of 1,000 subscribers. I would love it if you could help me out and subscribe to this channel. We're trying to hit that 1,000 subscriber mark to get one of the milestones to be monetized as a YouTube channel. That's one of our targets for the new year. So if you haven't already and you found this content valuable, definitely consider subscribing. And yeah, any questions, always feel free to reach out. All the best.